Good day. Welcome to Module 2, Working Capital and the Cash Flow Statement. Today, we're going to start with covering working capital. As we talked in our previous video about the business cycle, the time of it, and this gets us a more in-depth of what makes up working capital and how it is used. So let's start with some definitions. The first one is a gross working capital. These are current assets used in operations. Okay? Keyword is used in operations. So that will include our cash, inventory, accounts receivable, prepaid expenses. It excludes marketable securities and excess cash because they're held for future investment and not part of that cycle, the current cycle. So when you're computing the gross working capital, the first thing you need to make sure is do not include any excess cash or marketable securities because it's not part of the working capital cycle. Okay? They're held for the future. Now, in the case of Geneseo Coffee Company, what we found, and sometimes it's helpful if you actually have two screens, this would be easy. Just put Geneseo Coffee Company up on one screen and you can follow along. Otherwise, you may want to have it on a split screen or however you want to do it to be able to better see it. But when we look at Geneseo Coffee Company, it's their cash, accounts receivable, inventory, and that's current assets used. Now you notice that's not total current assets. That's only total current assets used as part of the working capital cycle because they have $100,000 in marketable securities. So that's gross working capital. Pay attention here to the definitions, gross working capital. Just to give you a little bit background, that as we move forward on this, my assumption is once we define these, that you have the ability to calculate gross working capital for your company that you're working on, but any other company that I may cite. So on the midterm and the final, there'll clearly be compute the gross working capital for company ABC. And you're going to have to go in, find the 10K, open up the 10K, make sure you use the right pieces. So some of this is knowing where to get the information and what different things are asking for. So that's just sort of a little heads up as to how things work. Now we have this working capital, gross working capital, and the company needs to fund it. And by funding it, I mean if you have assets, remember debit and credits, don't forget debits and credits, is if you have this $1,360,000 in assets on Geneseo Coffee Company, the firm needs to fund that. It means there needs to be a liability to support that. It can be funded in a number of ways. One, non-interest bearing, and that's accounts payable and accrued expenses. So that's not costing us any interest. Interest bearing, well, we could look at that two ways. Is you could have short-term borrowing, lines of credit, long-term funding, borrowing or debt, or it could be equity. So the key is from a managerial perspective, if you have working capital, okay, you need to fund it. Now, if you want to grow your business, that would mean you'd need more working capital, thus you would need to fund it. Now, obviously, it would be better to use all non-interest bearing. Okay, that would be ideal, but that's not always practical. So a company will fund it either short-term with lines of credit or long-term permanent capital, it's called, borrowing or debt. Remember, borrowing or debt has an interest cost. Equity does not have an out-of-pocket expense, but it has a cost because an investor expects a return. Now, they need to do this in an effective way. They need to have a sufficient amount to fund both current and future operations of the company. If there's not enough working capital, the company will be unable to grow. Okay, and this is what I've seen with a lot of small and medium-sized business, is they simply don't have enough working capital to be able to grow. Because just remember, come back to the cycle. So if you're going to put more volume through that cycle, you have to put more money out before the cash comes in. Okay, that's inventory, accounts receivable. So that's going to go up before the cash comes in. So you need to be able to fund that working capital. And you want to minimize the cost of it, and that always results in a mix of interest and non-interest-bearing funding. The speed by which this works through the working capital moves, the faster the working capital can move, the cycle work, then you will actually need less. But if you want to grow your business, you need to be able to grow working capital, which means you need to have the funding of it. So there's a relationship there. Now, there's another definition of net working capital, and that is current assets less all current liabilities. This includes both non-interest bearing and interest bearing, and it's included on the basis that the turnover of the working capital generates the cash to satisfy interest-bearing liabilities in the coming up year. Now, that's a very simplistic model because it ignores the fact that this is a going concern. Okay, you're assuming that a business is continuing in operations. If it doesn't have if the turnover of it is not enough to pay the current portion of long-term debt, the company is in trouble. But most companies need to generate it. But we compute it, and for Geneseo Coffee Company, you can see that its total current assets, $1,460, less current liabilities, and gives us a net working capital. The next piece, the third one, is net working capital. Now go back to the first. So it's the gross, okay, gross working capital, which are the operating assets, less operating liabilities. These are your non-interest-bearing liabilities. That includes your accounts payable and accrued expenses. The normal business is partially funded by the fact that materials enter the cycle before they are paid for. Ideally, a company would want to fund 100% of the working capital with accounts payable and any accrued expenses. Now, that's not usually practical because if you're paying somebody in 30 days, it generally takes more than 30 days for the cycle to run. Now, when you start looking at your own companies, you may find that in some of them, the accounts receivable is actually pretty small as a dollar amount relative to sales. Now, the reason for that is that if you're looking at a retail business, most do not extend credit themselves. What happens if you go and buy something, you're either going to pay cash or use a credit card. When you, the consumer, use a credit card, the store you buy something from usually gets paid within a day or two. Okay? So you're going to find that part in a retail type business is going to be relatively low. But where you're going to have the longer cycle is in inventory. So ideally, if you could turn the inventory and the accounts receivable within 30 days, which is what your vendors may give you, it's possible. But it's usually not much. You have to distinguish between possible and probable or practical. There is always a long-term amount that needs to be funded. Okay? So let's just take another look here at Geneseo Coffee Company. We're operating working capital. There's the current operating assets, less current operating liabilities, net operating working capital, 905. So this is the amount the company needs to fund using debt or equity. And you can see from their balance sheet that they have funded it through a mix of debt and equity. Why is this important? Okay, it served as the basis for being able to manage the cash of the organization, current and in the future. It's an ability to measure the performance of an organization and a basis for identifying opportunities to improve performance. But this is always taken within the context of this business/cash cycle. Okay, this is the numerical side of what we talked about in Module 1. Let's take a brief look again at Geneseo. Okay, let's take another look at Geneseo Coffee Company. And when we're looking at working capital, we always start with the balance sheet. So then we go over to the tab, Working Capital. And what we can see is that gross working capital are current assets used in operations. They exclude marketable securities. So all I'm bringing over is the 150, the 460, 750, and that totals up. So we can go back over 150, 460 plus 750, 150, 460, 750. So for Geneseo Coffee Company, gross working capital for the year, and this is what we can do. Now watch, I'm just going to do a few things here because Excel becomes important. And this becomes what year? Okay, so it's a point in time. So what I'm going to do is I'm going to bring this over. Okay, now I know I want to calculate it for the past 3 years. So if I built a formula, I can simply copy, paste, copy, paste. Now, I've done it now. I've computed the gross working capital, as you can see there, by simply copying the formulas. But I got to go back and make sure they're right. Okay, so 8324.50, 8324.50, 5250, 300, 5250, 300, 600. So now I know the gross working capital for each of these years. Now, what we can interpret that, and let's look at that for a second, we see it growing. Let's relate it back to the sales. Sales were going 4.5 million, 5 million, 6 million. So as we've grown sales, we've needed to create this working capital. Okay? So that's to show us what's being used to... So now I'm developing, notice I'm thinking as I'm going. Now, this is what I'm trying to demonstrate, that part of critical thinking is for you to go deeper. So what I've done is I want to look at gross working capital relative to sales. So let me just put in total sales. And I'm going to take the sales and now we can see this relationship between total sales and working capital. So the greater the sales, the more cash we need, the more accounts receivable generate, so we need to fund that. And the same thing, inventory. So we want to look at gross working capital in relationship to total sales. Now we can look at net working capital, which is the difference between current assets and current liabilities. And this is when we include. This one here, we exclude marketable securities. And if we take this 1460, right there, okay, we bring that over, and then we subtract the current liabilities, financials, current liabilities, 554. Notice we're including everything. Okay, so now I want to compare again the 3 years. So what I can do is, you want you to build these things in Excel using formulas, because now I can just copy, paste, and I can see a very similar trend. So now my net working capital, okay, is the 1,360,000, which is my operating assets or my gross working capital, less my current liabilities that are not interest bearing. So if we go back over here, we could see that's only 454, and that brings us back here, and you can see that we have net operating capital of 905, 316 in the prior year. Okay, so we've seen a material change, This is where, when we move into the next statement of cash flows, we'll be able to understand what that is. So take another look at this, and then we're going to continue on cash flow statement. One of the things that you're going to hear me say this week, and probably continuing, is cash is the lifeblood of every organization. Understanding how cash moves around becomes very, very important. Because without it, you can't grow, you can't pay people. It's very important. So one of the statements, we looked at the balance sheet briefly, the income statement. We're going to spend some more time on the cash flow statement. Essentially, what the cash flow statement is, it talks about where did cash come from and where did it go? How was it generated and how was it used? And it's broken down into a couple of big categories. It's broken down into operating cash flows. It's broken down into where cash comes from operations, from selling things in the normal course of business. That's a cash flow from operations. Then there's cash flow from investments. That means making an investment in new property, plant, in equipment. And when we look at that, it can generally, cash is used there. But if you were to sell certain assets, it would provide cash. But we consider that investment. Coming back, it's not part of that operating cycle. This relates to longer-lived assets. If it's part of the working capital cycle, okay, that comes from operations. Then there is financing cash flows. Did we borrow money? Did we repay money? Did we issue debt? Did we buy stock back? Did we pay dividends? So it's about financing the company. So we really got, these are the three sources of where cash comes from. It comes from and or used. So it comes from operations, that's running the business cycle. Okay. The second is from investments, and the third is from financing. So it's got to come from somewhere. Then we have the all-important other cash flows. Okay. And other cash flows, you never know what it is. So we got to read and do research more. And those are things that, from an accounting perspective, the accounting folks have decided that it's really not operations, it's really not investment, it's really not financing, it's other. So in that case, we need to find out why. Now, what I have is I actually have a few slides that I've used previously. Unfortunately, they're dated, but the concepts are no different. They're still here. And what I looked at is Colgate. And what you can see is over the 3-year period that this is the cash provided by operations, $2,896,000, $3,002,000, $3,002,000, but we're seeing it decline. Now, what did they invest in? $1,002,000, $1,002,000. Used in financing, $1,002,000. Effective exchange rates. Okay, so they're considering that the change in effective exchange rate changes, okay, that's the value between the dollar and the foreign currency, isn't really operations investing, it's other, and that's fine. So when we add them up, these three up, we see that there was a net increase of cash of $388. And the way it works is they start out with, this is where the cash came from, net increase, decrease in cash, plus what was there at the beginning is the ending. Okay, so their cash balance and cash equivalents went up. Okay, so what we're seeing is that cash from operations was $2,896,000. They used $1,913,000 for investing and $1,002,000 in financing. So they repaid debt. So what you're seeing here is that the cash flow to run the company comes primarily through operations. And what you're seeing is this is very typical of a more mature business because they've already made the investment and they're sort of harvesting, if you will, the benefits of that. So you see that capital there. Now, in contrast, a startup company would obtain more cash because they need to make the investments in the future. So they may not have enough cash from operations, like we have here, to pay for all of this. so you might see them borrowing more. So it's really to look at changes and understand what's happening. But this is a very summary cash flow, okay? So you can see that it comes together. So you start with cash from operations, always the first source of cash. Then you're making an investment in the future, okay? And this can be a positive or a negative. You can either use the money or you can generate it. Financing, and then others. And we see that this is a mathematical formula here that when we add them all up, the cash increase, decrease in cash has to be the difference between the ending cash and the beginning cash. Okay? Make some sense? Good. Hey, if you got a question, that's not fair to you guys to say, here, I'm talking and recording this. You can't. If you got a question, make sure you ask it. Use the questions and or email me for that. Now, when we look at operations, that's the business cycle again. This doesn't include fixed assets. So it starts with net income, which is computed on the income statement, and it adjusts for income and or expenses that were recorded in the income statement that did not provide or use cash. Okay? So we have depreciation and amortization are non-cash expense. So there was no cash. So if a company has $10 million of depreciation expense, there's no cash that went out. The cash went out when they bought the equipment in the investing section. So we add that back. There's a lot of other things that are non-cash too. So those are outlined. There could also be expenses that were not recorded that use cash. And that's where we look at the cash flow statement. Changes in working capital items. Now, we know what working capital is. We know what the working capital cycle is. So changes in those are either using cash or providing cash. Keep coming back. This is about the working capital. So working capital is part of operations, part of this business cycle. We have deferred taxes. We have stock compensation. These deferred taxes and stock compensation don't always use cash. So we add them back because they're not a cash deduction. At times, they may go the other way. And then we have other items. And with other items, we always want to understand what it is. So just to summarize quickly, from operations, you take one, net income. You add back non-cash expenses or income, and then changes in working capital. That gives us net cash provided from operations. If we're looking at this in Colgate, we start out with their net income, and very clearly, adjustments to reconcile net income, including non-controlling, to net cash provided. So we're adding back depreciation and amortization, restructuring and termination. Come back to our debits and credit. What they did in this case is they didn't pay it in cash. So there was a debit of $103 million to restructuring costs and a credit to payments to employees as they downsized. It wasn't paid. They had a gain before taxes on sale of non-product, non-core lines, voluntary plan contributions, and we can see here that these are all non-cash expenses or income because you don't want to include things that didn't generate cash or use cash. Then we see right here, here's our change in working capital items. So net cash provided by operations is 2.8. So you can see, generally we want to see that income is greater, or the cash flow is greater than the income from operating. In operations, there's always another. And the questions that you need to ask yourself are, understand it. How are you going to understand it? You're going to look at the notes to the financial statement, the management discussion. How did it impact the income statement? Come back, debit, credit. How did it impact the balance sheet? Did it use cash or generate cash? How will the future be impacted? Is this a one-time or recurring. Okay, this is where the debit and the credit comes. Anything in other, you have to look at it and say, where are the debits, where are the credits? Because that will tell you the income statement, the balance sheet. Then you got to find out, did it use cash or use cash or generate cash, or neither? How will future periods be impacted? Okay, so if you do an amortization, or if you do a restructuring charge, we should see that expenses in the future will be lower. Is it one time or recurring? So that's our operations piece. So that's where cash flow comes from. Next piece to looking at is investing. Okay, what is the company doing for the future? Are they acquiring new companies? Are they buying more property, plant, and equipment? Or are they selling property, plant, and equipment? Or other? What was it for? Now, when we look at this thing right here, property, plant, and equipment, this is also known as CapEx, capital expenditures. Okay? So this is what they're investing in the future. So we want to see a company making investments in the future. We don't want to necessarily see them selling off property and equipment. And when we look at Colgate here, is you can see there's our net cash provided by operations, and it blows it up. There's our CapEx, capital expenditures. This is purchase of property and equipment. Okay, this becomes an important thing because this is what's going to generate revenue in the future. Now here they had a gain, the sale of property and non-core product lines. So they're exiting a business. Now in this case, what we could see here in the investing is purchases of marketable securities and investments, proceeds from sale of marketable securities and investments. So when we go to their balance sheet, we would have seen a net change. Now on the cash flow statement, under investing, you need to show purchases of marketable securities and sales. Okay, so a lot of times companies, when they have excess cash, will be investing in very short-term instruments, and every time they buy and sell, that's considered a purchase or a proceeds. So I tend to look at them net, but this is telling us that they're turning over pretty fast on that, and that they had an acquisition. Payment for acquisitions net of cash acquired. So we do know they bought something. So what was it? Okay, so we go, when it says here they spent almost $1 billion on an acquisition. So the question is, what is it? Okay, Sanex. They bought a company called Sanex. So that's an investment they made in the future. So that is something we do want to look up. Okay, and then other in this case is immaterial. We don't need to know. But what we do need to know is what did they buy? What did they sell? We find that in the notes to the financial statement, but more importantly, probably in management discussion. Let's look at financing now. How is the firm funding the company? This is the third part of the cash flow statement. Are they borrowing money or are they repaying money? This is again done on a gross basis, meaning that borrowings, even if you roll it over and repay it, it's gross. So this is the total money borrowed, less money repaid is the net change in debt, but we show it so that we can understand it. We could also issue stock, new equity. On the other hand, we could buy stock back or pay dividends. So this is how the company is funding itself. And then there's the traditional other. Let's take a look again at Colgate. What we're seeing here again is principal payments on debt, proceeds from issuance of debt. So we can see that they paid debt back, they issued new debt. Net, they went up. Why did it go up? They funded the company, the new acquisition. Dividends, they paid dividends to shareholders. So that's a financing activity. Purchase of treasury shares, this is when they're doing stock buybacks. Okay. They bought back $1.8 billion. Okay. And proceeds from exercise of stock options and excess tax benefits, used funds. So what we provided funds, and what we can see, well, let's go back. Proceeds from when somebody exercises a stock option, they have to make a payment for them at the strike price, okay? And they get the gain between the stock price and the market price. But we can see how they have used cash for financing activities. Other. What is it? We always want to know what it is. Now, as I said in the beginning, it's net cash. So we're starting with cash at the beginning of the period. We add cash flow provided by operations or subtract cash flow used in ops. Subtract cash flow used for investments or add cash flow provided. Add cash flow provided by financing or subtract others. Other. This gives us cash at the end of period. So if we start with the cash at the beginning and add where did it come from, so you start out with cash, okay? Then you're going to add how much came from or was used by operations. Same for investments, financing, and other. And that gives us cash at the end of the period. It's a reconciliation of cash. When we look at Colgate here, we can see this, that right down here on the bottom, that there's your beginning, there's your ending, and the increase in cash comes together for that. Okay? So the question is that too much cash, too little? But that's for more advanced. We just need to know what it is at this point. And when we look, okay, it does tie back to the balance sheet. Okay? What can we conclude from the Colgate's cash flow summary? One, overall, there was a $3.23 million increase in cash over the years. Colgate consistently obtains its cash flow from operating activities. Typical profile for a successful company, and probably one that's in a more mature stage and not growing at a rapid pace. Their cash flow exceeded net income, and that's a desirable profile for almost every company. But you got to take a look at what's happening with working capital, because we would expect working capital to grow, which will cause cash flow to be used by operations. That's not on the short-term basis a bad thing. In fact, it can be very good. In every year, they had enough cash from operations to cover their capital expenditure. Dividends increased steadily over the past 3 years, and they had enough cash available after capital expenditures to pay those dividends. So represented a very positive profile. Now let's just take a very, very brief look at Geneseo. Taking a look at Geneseo Coffee Company, and let's compare that to Colgate. The first thing you're going to find is that Geneseo Coffee Company is much simpler, but the same concepts are there. Net income, which comes right from the income statement. Here's their non-cash charges. All they have is depreciation. But what they do have is changes in working capital. Okay? The accounts receivable went up 140. Inventory went up 300. Accounts payable went down. So let's go back over here, or go up. And as you can see, yes, accounts receivable went from 320 to 460. They sold more, right? Because they went from 5 million to 6 million. So they were able to do 1 million sales, and that increased the accounts receivable. Go back to the cycle time. It took a period of time. If we go over here and look at our cash conversion cycle, we knew that it took 30 days, 27.98 days, for the accounts receivable conversion. So we know there would be, if this is the time and sales went up, that amount would go in. Okay? So same thing when we go over here to look at inventory. Inventory went up. Well, yes, it went up because we're selling more, and since it takes them back over here to the cash conversion cycle, 57 days to move it, the inventory levels have to go up. Okay? So in this case, they actually used money for operations. Operations didn't generate enough to fund the increase in working capital. So what they had to do is they had to fund that somehow. So now they also purchased some property, plant, and equipment, CapEx, for $425. So here it is. They use $325 in operations, biggest piece being to grow the working capital, bought equipment. So where did that money come from? Well, they issued some preferred stock, $300,000. They paid some debt back. They borrowed, and they paid dividends. So net, the function of them issuing preferred stock and borrowing is what funded or paid for the increase in working capital, paid for the additional purchase of property and equipment. And it started with $70,000 in cash, increase in cash. So if I take $325 plus $425 equals $820, is an increase of $70,000. So if they had 80 at the beginning of the year, notice it all ties back over here, and they ended up with 100, which is 150 right there. So that's a picture of that. But as you can see, Geneseo Coffee Company is a growing company. We're seeing very rapid increases in sales, where with Colgate, we didn't necessarily. So that's Geneseo Coffee Company. What we're going to take a look at next is free cash flow. If you have any questions, please let me know.